Okay, hello everyone. We're going to get started to the world of futures. This is Bruce Westra for Courtney Smith and WealthBuilder, presenting the first of three in a series of future seminar that are going to explore the world of futures trading. We hope to give you a lot of good information, and I just want to thank you all for being here and showing up and making this series a success. Be sure to register early so that you get a seat. All right. So we get started with the disclaimer, and be sure to check out the disclaimer carefully. After all, the government knows best. So here's the future. Not the future, but the futures. I love that picture. Reminds me of the Jetsons when I was a kid. So the futures and Forex. Many people, especially new traders, think that the futures and Forex markets are the same. It's probably because you often hear the names linked. Like I'm a trader, I trade the futures and Forex. You may actually hear this at a cocktail party. And when you do, you reply, I really like the Aussie dollar because of the correlation with the pound yen. And you have just become the hit of the party. People look at you and go, oh man, what a smart trader. So the futures and Forex market. The Forex market trades currency pairs. And we discussed quite a bit about that in the last 3 weeks. But the futures market trades commodities and financials contracts. So some futures terminology. You often hear traders using commodities and futures kind of interchangeably, much like traders will also use stock and equities interchangeably and equally. But we know from our discussion of stocks, they're not quite exactly the same thing. And what traders really mean when they talk about commodities are the actual physical goods, kind of like gold or soybeans or copper. And futures, to be precise, are contracts that are traded at a futures exchange, exchange like the Chicago Board of Trade, abbreviated the CBOT. A couple of things more I want to mention was that futures have expanded to include contracts on financial markets like the S&P 500, T-notes, and currencies. And also remember that when we trade with futures, a gold contract, for example, we're not trading the value of 100 ounces of gold. We're actually trading the value of a contract for future delivery of 100 ounces of gold. So it's kind of a fine definition, but there is a distinction there. So what are futures contracts? Futures contracts are contracts to make or take delivery of a financial instrument or a physical commodity sometime in the future for an agreed upon price. For example, the copper May 2013 contract or the 10-year notes for June delivery. In every contract, there's two parties. In fact, it's an agreement between two parties. One of the parties is in a short position, or the seller. He agrees to deliver a commodity, and the party is the one in a long position, or the buyer. He agrees to buy the commodity or take delivery. You can think of the arrangement as a farmer who raises a crop of corn. He can be the seller or short party, and the company who makes cornflakes being buyer for the long party. Every contract has both sides or position. The contract details are always spelled out in every contract for a futures contract. The quantity, the quality, the specific price per unit, and the date and method of delivery. In our corn example, it'd be 5,000 bushels of number 2 yellow December corn at $6.42 per bushel, transportation by train, and delivered in April. So keep in mind the contract specifications mainly apply for the producers and the buyers of the commodity, like the farmer and the cereal factory. As traders, we are only caring about certain specifications. Specifications are also known as specs. And we'll go over those specs and spec charts next week. If you're new to futures trading, there's so much information about the commodities and contracts, you may be going, how do I know which is the correct contract to trade? Well, let's look at some of those answers to that question. One place that you can find the correct contract to trade would be Courtney Smith's Follow My Trade. You can sign up for this service and get the actual trades that he does on a daily basis. You can ask your broker's trading desk. Just phone them up and go, hey, I want to trade corn or wheat. What's the correct trading contract right now? And when should I roll it over? You can also look at the volume on contracts. For instance, if you look at the volume on the copper March 13 contract, you see that the volume is about 129 contracts. But if you look at the May 13 copper contract, you see that the volume is about 51,000. So the question is, which one is the Roach Motel and which one would you trade? So if you said the Roach Motel was the March contract, then you'd be right. Futures contracts are traded on exchanges, and this is another big difference between futures and Forex. Forex, as you know, is not exchange traded. It's traded on a worldwide net of over-the-counter dealers. However, futures are traded in exchanges, and these exchanges all have different hours for different commodities. For instance, if we look at the E-mini crude oil, it trades on the NYMEX. The NYMEX stands for the New York Mercantile Exchange. And for that particular market, the crude oil market, it opens at 6 o'clock in the morning, 6 o'clock a.m. Pacific time, and it closes at 11:30 a.m. Pacific time. So if all you did was trade crude oil, it lived in the Pacific time, you'd have to get up kind of early, but your day would be nice and short, be over at 11:30. Silver. Silver trades on the COMEX, which is the Commodities Exchange, which is a branch of the New York Mercantile Exchange. And that market, the silver market, opens at 5:25 a.m. Pacific time, and it closes at 10:25 a.m. Pacific time. So again, a nice short day. I want to give you all just a brief history of futures exchanges. Way back in 300 BC, Aristotle wrote about the first futures trading. An interesting story. This guy named Thales, he was a philosopher, and he predicted that the olive harvest would be really good the next year. And he went around to all of the olive press owners and contracted the use of the olive press for the next harvest season. As things turned out, he would find that the harvest was actually a very good harvest. And since he controlled all the contracts for the olive presses, he was able to sell them at a very good profit and make a lot of money. The next one that kind of shows up in history is in the 1600s and in the Dojima exchange in Osaka, Japan, trading rice futures. It was established in 1697, and the brokers actually controlled the prices of rice, and thus they controlled the Japanese economy because it's a rice-based economy. In the United States, in the 1800s, Chicago emerged as the logical commodity trade center because of its location at the base of the Great Lakes. It was centrally located for the farmlands and the cattle country, so it was a natural location for agricultural commodities. In the 1800s, merchants began to use the concept of futures or forward contracts, which would let them lock in a price and allow them to hedge against adverse price changes. But at first, these contracts were not always honored by both parties, and they were very illiquid. So an exchange needed to be developed to bring the buyers and sellers together and to standardize contracts. And in 1848, the Chicago Board of Trade was formed. And in 1865, standardized futures contracts were introduced. In 1882, the New York Mercantile Exchange was formed. And in 1919, the Chicago Mercantile Exchange, or the CME, was developed or formed. 1933, the COMEX, which is the Commodities Exchange, was formed. And in the 1970s, financial futures were introduced by the CME. In 1992, the CME introduced Globex, which is the electronic trading branch of the CME, and now the Globex handles 72% of all of the trading done by the CME. The other remainder is still floor trading. And in 2008, the Chicago Mercantile Exchange took over the New York Mercantile Exchange and the Commodities Exchange. So that's probably more history than you really wanted to know, but I thought it was interesting, and I also think that it helps round out our education as futures traders. So how does a futures market work? Well, the purpose of a futures exchange is to act as an intermediary between the buyers and sellers. This helps minimize the risk of default by either party. So to do this, the futures exchange requires each party to put up a margin. And a margin is an initial amount of cash so that these trades can be done. Since the futures prices will change daily, the exchange will take money out of one party's margin account and put it into the other party's margin account to account for the changes from day to day. And so each person, or each party really, will show the appropriate daily profit and loss. If a margin account goes below a certain value, a margin call is given and the account owner must replenish his margin account. This whole process that we're talking about right now is described or called marking to market or marked to market. And as a result of this marking to market, on delivery date, the amount exchanged between the parties is the spot price for the contract, because any daily profit and loss is already settled out by this marking to market process. So futures margin. What is a futures margin? Well, for us, futures margins, as traders, futures margins are basically a good faith deposit that you have to put up to execute a trade on a futures contract. Similar to Forex margin that we've discussed. But where the Forex market uses a fixed ratio, 50 to 1 or 20 to 1, for all pairs that you're trading a broker, the margin for futures contracts vary with each futures market. In other words, the margin for silver contracts is different than the margin for, let's say, soybeans or gold. So each market, futures market, has a little bit different margin that one would need to put up. So there's three terms that I want you to know regarding margin. The first is initial margin, and that's the amount that you must put up to put a trade on or start the trade. It varies, as we said, with each futures contract, and your broker will definitely let you know what each one is. The next term that we want to look at is margin maintenance. Margin maintenance is the minimum amount of money that you must keep in your account before you have to add money to bring the margin back to the initial margin level. For example, let's look at soybeans. A soybean's initial margin, let's say it was $2,000, and the maintenance margin is $1,500. So if soybeans drop in price, $500, you would need to put in at least $500 to get back up to the $2,000 initial margin. A margin call. So margin calls are when your broker demands you to add money or put more money into your margin account because it's below the initial margin maintenance account. And if that happens, he either tells you to put money in and or he'll actually close your position until you put more money in and get your account back so that your initial margin is valid once again. So initial margin is the amount of margin that you need for every futures market to put a trade on. The margin maintenance is that amount that the account cannot go below before you have to put more money in. And a margin call is a demand from the broker, hey buddy, put more money in, or I'm going to close your position, or I already did close your position. The margin call is interesting if you ever get a chance to see the movie named The Margin Call. It's an interesting look at trading in the United States. So futures margins determine how much it costs to trade a particular market. And these margins are determined by the risk and the volatility of each particular market. The initial margins vary greatly, and they change as market conditions dictate. And your broker will definitely give you the cost of each contract margin. So gold has a higher risk and volatility than corn does, so you would expect the corn margin to be higher than corn, and in fact it is. It's about $6,000 for the gold margin and about $2,700 for the corn margin. So many of the high price or big contracts like gold or oil also have mini contracts, and the gold mini contract is only about $2,000 for its margin. The oil mini is about $3,000 for its mini contract margin. So the margins are calculated by the exchanges and they use a computer program, and that computer program takes into account a lot of variables, but mainly volatility. So your cost on margins is whatever the exchange sets plus whatever the broker adds on. Sometimes the broker will add on money that you need to put up to help mitigate their risk. So remember, it's not a set ratio like Forex margins, but they vary with each contract. So how do we make money with futures? Well, we are speculators, also known as traders, in the futures market. And as traders, we're not required to hold the contracts for their duration. So we can buy a May corn contract in March and sell it in April before it expires when the price is higher for a profit, or vice versa. We can sell a May corn contract in March and buy it back in April before it expires when the price is lower for a profit. And that's how we make money in the futures market. Of course, this means that we have to study these markets and do the proper analysis so we know whether to buy or sell them, and also execute flawlessly. So how do we start trading futures contracts? Well, we need to get educated first because we have to have the proper psychology, the proper risk management, trading methods, know the futures contract specs, know our order types, and we also have to know our broker's trading platform so we can actually put the trades on correctly. So all these things we have to be educated on. And I would be doing you a disservice if I said, all right, this is the futures market. Let's get going and start trading on it. We really need to get headed up or educated on all these various factors before we start trading futures. Because a one-day movement in futures can easily be thousands of dollars worth. The cool thing is that there's only about 30 or so futures that we need to learn about. Those are the ones that we actually trade. All right, so next week we're going to talk about future specifications and contract rollover. So So your homework then is to Google futures contract specs, look up a bunch of them, and start to get familiar with them. All right, so we can take some questions. And some examples of CFD minis. Well, CFDs are actually miniature contracts already. So if you're trading CFDs, which are contracts for differentials, they're traded on AvaFX, or because American brokers can't trade with CFDs. So if you're using AvaFX, then you can trade CFDs. So they're actually mini contracts already. So what are financial futures? These are currency contracts or interest contracts. Basically, T-notes, the 10-year T-notes is our government selling their debt to us and then paying us interest. Yes, futures margins are different than the margins that you use for shorting stock or options. Each market, the futures market and the options market, all have different parameters for their margins, and they don't apply across the board. Do you have a list of the 30 futures that we should trade? Yes, we do. We can get them to you if you're interested. Just write into Bruce W. at WealthBuilderLLC.com, and we can give you a list. Jennifer says, thanks for all the information tonight. You're welcome, Jennifer. It's my pleasure. I really enjoy doing this. Although I must admit, I'm not quite over being totally nervous about giving you guys all this information. Are CFDs futures contracts? Actually, they're clones of futures contracts or little mini contracts, which you can trade in foreign exchanges, foreign brokers, I should say, not foreign exchanges, but foreign brokers, like AvaFX, or brokers that are based in the UK or another country. Because like I said, our government doesn't think that we are quite bright enough to trade, American citizens, to trade CFDs. Does a margin account mean you're borrowing money from your broker or using your own money? It actually means that you're using your own money, but you're putting up a good faith deposit so that you can use brokerage money to control a ton of money. In other words, you put up $2,000 or $3,000 or $5,000, $6,000 to control $100,000 or $150,000 worth of broker money. That's where the leverage comes in. And we'll go more over this next week. So I don't really want to beat it to death. But no, you're not borrowing that money. You're putting it up yourself. It has to be money in your account already. Next week, we're going to talk about seasonal futures charts.com. Thanks, Paul. And we'll go over that thoroughly. Next week, we're going to cover contract specifications, which we also know as contract specs. And those specs, one of the places where we'll find them is at the seasonalfuturescharts.com. But there's other ones that I want you to look at also. The seasonalfuturescharts.com is Courtney Smith's own website. So we definitely want to plug that. We're also going to cover rollover, contract rollover next week. So what's the smallest amount of funds that you can have to trade futures? That's a good question. And it's a personal finance question. However, logistically, to trade futures contracts, the very minimum I would say would be 50,000, but 100,000 is way better. And I'm not saying that for personal finance question and answer. I'm just saying logistically, to realistically trade futures, you need to have a little bigger account size than you would to trade Forex. Thank you, Eva. Eva says, I'm a wealth of information. I do my best, Eva. Florence, I hope I answered your question okay. Let's see. Will I be at the Peak Potentials Futures, FTU at the end of the month? Yes, I will be. And I would really like if all of you that go to that seminar come up and introduce yourself. I'd really like to put faces with names. So please come up and introduce yourself. Okay, everyone, that's all I have. As you can tell, my voice is trying to give out, so I got to jump. So you can send me your questions at brucew@wealthbuilderllc.com. And for more information about Courtney Smith and seminars and programs happening near you, visit www.wealthbuilderllc.com. That's all. See you next time.